Gold didn't break out politely. Gold forced its way higher, and the dollar's slide just gave it permission to run. But the part nobody wants to say out loud is that this isn't just a headline move, it's a credibility move. And the market is trying to reprice it before the rest of the world even agrees on what just happened. Because right now the fight is simple. One side wants you to believe this is a temporary panic bid that will fade the moment the news cycle moves on. And the other side is the actual plumbing of the market. Spreads, hedges, inventory preferences, cross-border demand, quietly telling you the bid is deeper than the talking points. And later in this video, I'm going to give you the exact next 2 weeks checklist. What levels matter, what confirms the thesis, what breaks it, and why the calendar is the catalyst that can turn a normal pullback into a very abnormal squeeze. Here's the snapshot you need in your bones before you even think about an opinion. Gold just printed fresh record territory in the mid 4,500s and tagged above $4,600 while the dollar weakened broadly. And that combination is gasoline because gold is a globally priced asset, and the dollar is the measuring stick. When the measuring stick bends, everything measured in it looks like it's exploding. But that's not the part that matters. The part that matters is what forced hands behind the scenes, who had to hedge, who had to cover, who had to source, and who suddenly couldn't pretend they were fine being underweight a metal that's been refusing to die for a year. And that's where the real pressure starts. The mainstream narrative you're going to hear is clean and comfortable. Safe haven demand because of political drama, plus a weaker dollar, end of story. It sounds reasonable, it sounds tidy, and it gives everyone an exit ramp. Because if you accept the deeper interpretation, that the market is repricing the credibility premium embedded in US policy and in the dollar itself, then you have to admit something uncomfortable. This move has a structural component, not just an emotional one. And markets can fade emotion. They don't easily fade structure. So the incentives are obvious. Funds want to frame it as noise, so they can trade it like noise. Institutions want to frame it as noise because structure forces portfolio decisions, not day trades. And the average investor gets trained to treat every spike as a trap, so they don't even try to understand the mechanism. But that's exactly how you get blindsided when the mechanism is the trade. Here's the hidden detail that reframes this entire story. The price you see on your screen is the loudest number, but it's not always the most truthful one. The truth often leaks out through stress signals, through the way physical demand behaves versus paper claims, through the way regional pricing diverges, through the way inventory chooses new homes, through the way hedgers behave when the dollar slides at the same time as policy credibility gets questioned. If you want one metric to respect without worshiping it, it's this. The relationship between physical demand and paper hedging doesn't stay balanced forever. When it snaps, the screen price stops being a suggestion and starts being a chase. And if you've been around metals long enough, you know that chase can be violent, fast, and psychologically brutal. Now, let's make it concrete without turning this into a textbook. Gold trades in layers. The layer most people watch is futures and spot. Fast, liquid, leveraged, narrative-driven. But underneath that is the layer that decides whether dips are bought or become air pockets, the physical pipeline. Refining capacity, logistics, vaulting preferences, regional demand, import quotas, and the simple fact that physical metal cannot be conjured with a keystroke. Futures can move the quote in a second. Physical tightness determines whether the market can actually absorb that quote without coughing it back up. And here's the catch. The physical market doesn't need to be out of stock for it to matter. It only needs to be tight enough that marginal buyers pay up, that delivery preference shifts, that the flow is one way for a stretch of time. When that happens, the paper market starts to behave differently. Shorts get less comfortable. Dealers get more cautious. Spreads start sending messages. But that's not the part that matters either. The part that matters is what the dollar weakness does to every participant's incentives at the same time. A weakening dollar isn't just a mood, it's math. It changes the local currency cost of gold for every non-U. S-buyer, it changes hedging behavior for importers and exporters, and it changes the psychological framing of safety, because it makes people ask a question they hate asking. What exactly is the risk-free asset right now? When the dollar is firm and policy is stable, the world can treat U.S. assets as the center of gravity. When the dollar softens during a period where policy credibility is being publicly tested, that center of gravity starts to wobble, and gold is the oldest shock absorber in the system. This is why the conflict is so intense. Because gold moving higher is one thing. Gold moving higher while the dollar weakens and confidence gets questioned is another thing entirely. And if you're watching from the outside, it can look like hype. From the inside, it looks like positioning, it looks like risk management. It looks like people being forced to stop pretending. Now, you want evidence, not poetry, so let's stack proof the way markets actually stack it. Proof point one is the price action itself. A record print above $4,600 isn't a gentle drift. It's a statement that the market accepted higher levels even as everyone waited for a reason to fade it. And the moment you see that, you should immediately ask, Who was on the wrong side and why were they there? Because big breakouts aren't powered by the people who already believe. They're powered by the people who didn't want to believe and got trapped. Which brings us to proof point 2, the dollar. Broad dollar weakness doesn't just help gold. It changes the entire hedging landscape. If you're a global allocator, a weaker dollar raises the relative appeal of gold as a neutral reserve asset, and it pressures anyone who uses the dollar as the default hedge. The more the dollar slips, the more gold becomes a hedge against that slip itself, not just against inflation or geopolitics. And that reflexivity is real. But here's where it gets interesting. Proof point 3 is what I call the street symptom. When a metal is truly in demand, you don't just see it in price, you see it in behavior. You see it in how quickly dips get bought. You see it in how dealers talk about liquidity. You see it in the way premiums in certain regions behave relative to the global benchmark. You see it in the way physical buyers respond to volatility. Do they pull back, or do they use it as cover to accumulate? And that is the detail most people miss because it's not on the front page of a charting platform. Watch the spread between regional physical pricing and the global benchmark. If that spread stays firm or widens into volatility, it's telling you real demand is leaning into the move. If it collapses or flips into a persistent discount, it's telling you the breakout is more paper-driven and more vulnerable to a pullback. That one observation alone can keep you from getting emotionally manipulated by the next violent flush. Proof point 4 is inventory preference. Not just how much gold exists, but where it is and why it's there. London Vault data, for example, gives you a real-world view of how much metal is being held in the biggest professional storage ecosystem. When holdings rise meaningfully month over month, it doesn't automatically mean tightness, but it does tell you something important. Custody is in demand. People are paying to park metal in the system. They are choosing the asset. And in a world where gold is acting like a credibility hedge, increased vault holdings can be consistent with institutional and sovereign preference for physical exposure rather than pure paper exposure. Proof point 5 is institutional flow mechanics. Even when retail is loud, the big flow pipes are quiet. ETFs, institutional mandates, reserve management, and risk parity style rebalancing. Gold doesn't need everyone to believe in it. It only needs a sustained marginal bid from participants who are compelled by policy, volatility, or portfolio rules. And those flows can turn a breakout from a moment into a regime. That's why the "it's just a panic bid" narrative is so dangerous. It tricks you into thinking the move is optional. Structural flows are not optional. They are process. They are risk control. They are allocation frameworks reacting to a changing environment. And the next detail flips the whole setup, the calendar. The market doesn't move in a smooth line. It moves around deadlines. It moves around expiries. It moves around meetings. It moves around moments where positioning gets forced to reconcile with reality. Right now, we're stepping into one of those windows. Late January has two features that can matter more than the news: a major Federal Reserve meeting on the calendar, and a cluster of options expirations and precious metals that can concentrate hedging flows. When you combine that with a fresh record high, you create a situation where the wrong kind of positioning can get squeezed. Not because the world ended, but because the mechanics demand it. Let me explain that mechanism without the jargon fog. Options reflexivity is basically this. When a lot of call options sit near the current price, and price moves up through those strikes, the dealers who sold those calls often hedge by buying the underlying. The more price rises, the more they need to buy to stay hedged. That can create a feedback loop where buying begets buying. It's not magic, it's math. And it's why markets sometimes rip higher in a way that looks irrational to anyone who isn't watching the option surface. Now, I'm not telling you this is definitely a gamma squeeze. That's cartoonish. What I am telling you is the conditions are there for options-driven acceleration if price hovers above key strikes and open interest is concentrated. And in a thin liquidity environment, those mechanics can matter even more. Liquidity thins, slippage grows, and small flows move big prices. That's why the calendar is not a footnote. It's a catalyst. And that's where the real pressure starts again. Because if this one level holds, the math changes. Here's how you translate all this into a concrete map you can actually use. First, define the battlefield. Gold has just proven it can trade above the $4,600 handle. That number matters because it's a fresh high, it's a psychological round zone, and at S where sellers who knew it, couldn't have taught, get forced to admit they were wrong. Above it, the market has less memory, less overhead supply, because nobody bought there before. That's where trends can accelerate. Below it, the market will test whether the breakout is real. So you need a near-term support zone to anchor your thinking. In a move like this, the first obvious zone is the mid-$4,500, the area the market traded as it pushed up. Call it roughly $4,120 to $4,560 as a working area. If price pulls back into that zone and buyers show up quickly, that's controlled pullback behavior. That's the market confirming the breakout rather than rejecting it. Below that, you watch a deeper line in the sand around the $4,150 to $4,180 region. Because if the move is real, the market often defends the prior consolidation in the first impulsive leg. If gold slices through that deeper zone and can't reclaim it, you're not watching normal volatility. You're watching a failed breakout risk, and the trade changes. And the next detail is what flips the whole setup. You can watch gold in isolation right now. You have to watch the dollar and rates as the trigger wires. For the dollar, think in terms of a reclaim. If the dollar index snaps back hard and reclaims a psychologically important zone, say the high 90s into 100 and above, and holds there, it can remove one of the biggest tailwinds for gold. It doesn't automatically kill the gold move, but it changes the fuel mixture. It makes gold work harder. If the dollar keeps leaking lower or fails every bounce attempt, gold's dips get bought more aggressively because the global translation effect stays alive. For rates, don't obsess over one day's yield print. Watch the narrative embedded in real yields and rate expectations. If the market starts pricing a more stable or easing path, that supports gold. If the market starts repricing higher real yields aggressively, it can create headwinds, even in a credibility scare, because it raises the opportunity cost of holding non-yielding assets. But here's the nuance, and this is where skeptics earn their edge. Gold can still rally with higher nominal yields if the move is being driven by confidence risk and currency weakness. That's why this isn't a one-factor trade. It's a regime trade. Mechanism plus narrative plus flows. And when those line up, you get what we're seeing now. Now, let's talk about the thing that manipulates most people out of good trades: volatility. Gold does not reward emotional certainty. It punishes it. The market will use volatility like a weapon. It will spike, pull back, gap, and rip again, specifically to trigger the worst possible decisions. Chasing highs with too much size and panic selling dips when your thesis is still intact. You need a psychology shield, not because you're weak, but because the market is designed to extract behavioral mistakes. Here's the shield. Separate trend signal from noise. Trend signal is what happens on the bigger structure. Breakouts, holding on retests, the dollar failing to rebound, physical signal staying firm, and volatility not breaking the pattern. Noise is the intraday flush that happens when someone runs stops, when headlines hit, or when liquidity is thin. The market will bait you into confusing noise for signal. Your job is to define in advance what would actually invalidate the thesis. Not, it went down today. Invalidation is structural. Invalidation is gold can hold the breakout zone on a retest and the dollar snaps higher with conviction. Invalidation is physical signals soften meaningfully while paper positioning unwinds. Invalidation is the move becomes purely momentum with no depth and then fails. If you don't define that line, the market defines it for you with fear. And that's not the part that matters. The part that matters is what you do next week and the week after, because that's where this setup either becomes a sustainable trend or a fast-moving trap. So here's the two scenario lens that keeps you sane. Scenario one is the controlled pullback. Gold cools off after the record print, dips into that mid $45,500 zone, and finds buyers quickly. The dollar either stays soft or bounces weakly and gets sold. Rate expectations remain supportive or at least not hostile. Physical signals, regional premiums, dealer behavior, delivery preference do not collapse. In this scenario, the breakout is being digested, not reversed. The market is building a base at higher levels. That's bullish. It is also the scenario that frustrates everyone because it feels too slow after the fireworks. But it's the one that creates longevity. Scenario two is the continuation squeeze. Gold doesn't give you the polite pullback. It holds above the breakout, chops for a moment, and then rips higher as hedging flows and FOMO flows collide. In that scenario, the risk shifts from will it fail or to will it gap? Because squeezes don't always offer clean entries. They move through levels quickly. They punish hesitation. They also punish overconfidence because squeezes end with air pockets. If you're watching for confirmation in that scenario, you want to see failed dips, quick recoveries after sell-offs, plus continued dollar softness and heightened volatility that doesn't break the structure. If you're watching for warning signs, you look for exhaustion, blow-off candles, extreme intraday reversals, and a dollar that suddenly finds a floor and rips. Because if the dollar snaps higher while gold is extended, you can get a sharp correction even if the bigger bull case remains intact. And that the part most people don't understand, a bull thesis can be right and your timing can still get destroyed. The market doesn't pay you for being right. It pays you for being right at the right time with the right risk. Now, let us tie the why now to the deeper mechanism so it doesn't sound like superstition. When policy credibility gets questioned publicly, when the independence of the central bank becomes a real market variable, Capital reacts in layers. First, you see the fast reaction. Dollar down, gold up, volatility up. Then you see the slower reaction. Portfolio managers reassess hedges. Reserve managers reassess diversification. Institutions reassess tail risk. That second layer can last longer than the headlines. And as you move into late January, those layers collide with mechanical deadlines, options expiration, position adjustments, and a Fed meeting that can intensify narratives about rate paths and policy independence. Even if the Fed does nothing, the expectations around it can move markets. Even if headlines cool, positioning can stay hot. This is why the price can whip around violently, even if the thesis is correct. Because in windows like this, price action is partly information and partly mechanics. It's hedges being put on and taken off. It's shorts being forced to cover. It's dealers rebalancing risk. It's funds managing drawdowns. That's not conspiracy. That's market structure. And market structure is relentless. So what should you actually watch day to day without getting hypnotized by every candle? Watch the dollar's bounce attempts. Not the down days. Those are already in the story. Watch the bounce attempts. If the dollar tries to rally and fails quickly, gold's bid is likely to stay supported. Watch how gold behaves at prior breakout zones. If gold dips and snaps back fast, demand is active. If gold drifts lower and can't reclaim, demand is passive. Watch volatility. If volatility rises but structure holds, that's often bullish in metals because it signals forced flows, not just enthusiasm. Watch physical indicators as best you can, regional premiums, delivery chatter, and whether real-world pricing behaves differently than screen pricing. And watch the spreads, the way nearby contracts trade relative to deferred contracts, because spreads can whisper when the headline is lying. If you need a simple rule, when people are screaming about the front page price, quietly check the parts of the market that are harder to fake. Those parts move slower, but they tell the truth sooner. Now, let's address the skeptic's best counterargument, because if you can't handle the counterargument you're not analyzing, you're cheerleading. The counterargument is that this move is driven by a burst of fear and political noise, and once the noise fades, the dollar rebounds and gold gives it back. That can happen. It has happened many times. Gold is famous for punishing late chasers right after a headline-driven spike. Also, gold at record highs invites profit-taking. Big funds take profits. Producers hedge. Options dealers reposition. Those are real sellers. So you don't get to pretend the only path is up. Here's how you rebut that counter-argument without arrogance. You don't rebut it with opinions. You rebut it with conditional mechanisms. If this is purely headline fear, you should see physical signals soften quickly. You should see the dollar reclaim levels with conviction, and you should see gold fail to hold the breakout zone on a retest. If those things happen, respect it. If they don't happen, if the dollar can't rebound, if gold's dips keep getting absorbed, if the market keeps accepting higher levels, then the move is not just fear, it's repricing, and repricing can persist. Also, there's a second counterpoint that matters: rates. If the rate path gets repriced more hawkishly, if the market starts believing higher, real yields are sticking around, that can pressure gold. But again, watch behavior, not ideology. Gold can rally in a high-rate world when confidence, risk, and currency weakness dominate. The question is, which force is stronger this month? And that's why you need a checklist, not a prophecy. Here's the checklist you promised you wanted. Confirmation looks like this. Gold holds above the breakout area on dips, ideally defending that mid-$40 $100 zone. The dollar stays soft or fails to regain key levels. Volatility stays elevated without breaking structure, and physical indicators don't collapse. Invalidation looks like this. Gold loses the breakout zone and can reclaim it after a retest. The dollar snaps higher and holds. And the move starts to look like forced liquidation rather than controlled digestion. If you want a single, simple, math changes line, if gold can hold above the prior breakout band while the dollar can reclaim its own floor, the pressure stays upward. If gold loses that band and the dollar finds its footing, the pressure flips. And if you've been watching metals long enough, you know the flip can happen fast. Now let's be honest about targets, because this is where trust gets won or lost. Nobody can hand you a guaranteed number, but you can map plausible zones based on psychology and structure. Above $4,600, the market has less historical resistance. That doesn't mean it goes straight up. It means momentum can carry farther than skeptics expect, especially in thin liquidity. A clean hold above $4,600 opens the door to quick tests of higher round zones. Think $4,700 and $4,800 as psychological magnets, especially if the dollar continues to weaken and the calendar mechanics amplify hedging. But here's the discipline. Those are magnets, not promises. The nearer-term risk is not missing the upside. The nearer-term risk is mismanaging the volatility that comes with it, because gold can absolutely whip $50, $80, even $100 in a short span in this kind of regime, and if you're sized wrong, you won't survive long enough to be right. So the mature approach is to treat this like a process. Define your time horizon. Define your risk. Decide whether you are trading the move or positioning for a regime. Those are different games. Traders care about levels and momentum. Positioners care about confirmation and invalidation. If you mix those mindsets, you'll do the worst of both. Chase like a trader and panic like a positioner. And the market will happily take your tuition. This is also where I'm going to give you a quiet warning, because it is the trick that ruins most retail investors in metals. Volatility will be used against you emotionally. You will see a sharp red candle and hear, it's over. You will see a sharp green candle and hear, you're too late. Both are designed to force urgency at the wrong moments. The antidote is planning. You decide in advance what you do on a pullback, what you do on a continuation, and what you do if it fails. You do not decide in the middle of the candle. That's not discipline. That's survival. And survival is the first edge. So if you want to be concrete about next week, watch for this sequence. After a record print, markets often test whether the breakout was real. If gold pulls back early in the week and buyers show up quickly, that's constructive. If gold chops sideways above the breakout and the dollar stays heavy, watch for acceleration into late January catalysts, because the mechanical flows can intensify. If gold gaps higher, be careful. Gaps can be gifts or traps depending on follow-through. If gold gaps and holds, that's strength. If gold gaps and fades hard, that's exhaustion risk. And while you're watching gold, keep one eye on the dollar and one eye on rates, because those are the levers that can either feed or starve the move. Now, I want to end with something that actually builds trust, not hype. You don't need to believe in gold. You need to understand why gold moves when it moves. Right now, you have a rare combination. Record highs, a weakening dollar, political and policy credibility stress, and a calendar window that can amplify mechanical flows. That's a potent mix. It doesn't guarantee a straight line. It doesn't guarantee tomorrow, but it does mean you should take the move seriously. And you should respect the mechanism, because the mechanism is what creates surprise. The crowd will argue about the headline. The market will trade the plumbing. If you're going to participate like a professional. Define your levels, define your invalidation, respect volatility, and keep your attention on what forced participants to do, not what commentators said they might do. And if you're the kind of investor who refuses to outsource your thinking, who wants the mechanism, the map, and the watch list instead of the slogans, then you already know what we do here. We track the pressure points, we track the calendar, and we don't let volatility turn us into someone else. Stay close to the signals, not the noise, and keep that two-scenario lens in your pocket, because the next move will reward preparation far more than prediction.